Good afternoon. Thanks for joining us. My name is Scott Zients. I lead the Economic Development Incentives practice at Voorhees, and we're absolutely honored to have you at the 6th Annual Voorhees Economic Development Incentives Conference. We're proud that in a few years, our conference has become the biggest annual Economic Development Incentives Conference in the country. We saw about 300 of you last year in person right before the pandemic hit, and we're really excited next year to see you in person again. For now, we'll make the best of this forum, and we thank you for participating. All we ask of you is to fill out the survey and give us some ideas for next year. Tell us how we're doing so we can try to make it even better next year. With that said, I'm going to hand it off to Jacinto to lead our presentation, along with Alex. So it's yours, Jacinto.
Thank you, Scott. I want to thank everybody for their time today and joining us. This session will discuss sales and use tax exemptions, abatements, grants and rebate incentives offered by various states and local jurisdictions. We'll be focusing on practical considerations on eligibility, the incentive negotiation, and incentive administration, among other topics. With regard to these types of incentives, for the purposes of our presentation, we're going to put them in two different buckets. One being sales tax sharing arrangements or grants or refunds relating to sales sourced from a specific project and taxable in the jurisdiction where the project is located. That'll be the first part of our presentation. In the latter part of our presentation, we'll focus in on exemptions from sales and use tax for outfitting or building a project, either for real property or machinery, equipment, personal property, with a little bit more of a focus or bent on the exemptions for construction materials. So to get us moving on, Alex, could you give us a sense with respect to why sales use tax exemptions or incentives?
Yes. Good morning, Jacinto, and thanks for having me. Alex Fry here. I'm with the CBRE and happy to talk to you all about this topic. Before we get into the specifics of that question, Jacinto, I think it might be for the audience, the context of the sales tax or use tax is one that has been around for a long time, right? So I'm a little bit of a history geek. I like it and have traveled and seen some of these things. For example, there's records of an actual sales tax dating back to thousands of years BC in Egyptian tombs. There's record of the Greeks and the Romans levying a sales tax to raise funds for wars and things like that. So the expression, you can't, there's certain things that are certain in life, death and taxes. Well, the sales tax has been around for a very long time, even preceding some of the income taxes that we're familiar with these days. But anyway, and also, for context of the discussion today, there's a sales tax, state and local level, generally speaking, but in the United States, only 45 states actually levy a state sales tax, and of those 45, 38 then also have some sort of, local jurisdiction type tax. So of course, if you're looking at one of those states that has an actual sales tax component to it, then this is the topic of discussion. The states that do not levy a sales tax, as many of you may know, if you're sitting in those states, Alaska, Delaware, Montana, New Hampshire, and Oregon are those states that don't have a tax at the state level. But Jacinto, to then transfer into the topic, right? And I don't see, do you have the slide shown on the screen? I don't see it on the live view for the audience to perhaps see. Okay. Oops. So I think that's slide number 5 here. Sales tax sharing agreements is what I see on the screen. So the benefits, right? So I guess the sales tax sharing agreements are a way of a project, a company, a deal to share in the sales tax revenue that would be generated by the business's activity with the relevant municipality there. So the benefit or the reason why these sales tax agreements are in place are numerous reasons why, but generally they help attract a company to a community that is looking to grow or diversify its base, and therefore providing an incentive for a company to locate there. In other cases, the reason is to help offset or mitigate or level the playing field between a competing location when a company is looking at different locations to do so. So one of the reasons why sales tax sharing agreements exist is for that. It's really to incentivize somebody to locate there. But the benefits for communities are that it would generate new revenue for those communities that wasn't there before, right? So if a business is looking to locate in a new town or a new city and is going to be, having a certain number of sales, and those sales will be subject to the tax, it's net new benefit to the communities. It's not something that they would be giving up or would be disappearing from their general funds. It's money that is a net increment to that. And so revenue raising is certainly a big piece of that, or reason why communities do that. But to attract the companies, to foster economic development, right? If they want to attract a certain type of company that then has a ripple effect of perhaps attracting a vendor or like companies to locate there is a strategy used in general on economic development. And of course, any community or state is always looking for job creation for political and fiscal reasons for that. And the benefits to the businesses, right, are, to lower some of the, to help offset some of the upfront costs that they might be putting into outfitting the facility, or in some cases companies move and have to offset, costs of shuttering other facilities, or, severance costs and things like that. But essentially it helps a company be able to invest in its business more, which then leads to perhaps more sales, leads to more job creation that will benefit a community. But Cindy, you and I spoke about this topic a number of times, right? And one of the things that we thought was important to hit on is, the fact that these sales tax sharing agreements can be very technical, right, in nature, as far as will a sales tax be actually generated out of this facility. So something that I'm sure we can address here.
Yeah, and we'll be discussing a little bit later in the presentation. Question for you: when you see these sales tax exemptions, do you see them as one-off incentives, or do you typically see them as part of a full package as a sweetener to the incentive package? Because my experience is that it's usually incorporated into a larger group of incentives. Right.
Yeah. So the answer to that, I wouldn't be a good consultant if I didn't say it depends. Right. So it'll depend on a number of things, right? It's where the project might be looking at, and what the tools are that a municipality, county, or state has at its disposal for economic development purposes, to see what the composition of those incentives might look like. But generally speaking, a sales tax sharing agreement would not be, the only potential benefit that could be offered to a company. So if a sales tax sharing agreement is being pursued in a community, is underwriting it and thinks that it's something favorable to the community, then there could be other incentives that are part of that, whether there's a property tax abatement on equipment or real property, grants for job creation, infrastructure sort of improvements to help with that. So it's not mutually exclusive. But in some cases, if the sales tax sharing is the one component that, will have the best result overall for a company, because sales tax sharing agreements can be depending on the level of sales, can be lucrative for a company that might just offset, what a property tax abatement might be, depending, again, where you're looking at in the country on a project. So not necessarily mutually exclusive, but generally part of a package that you would look at from a comprehensive perspective. And then, our job would be to help communities understand the impact of that project and the forecasting about the project, so that they can, sort of help underwrite the deal and define the return of investment on the project to see, what level of these sharing agreements they're providing, along with potentially other types of incentives.
Sure. Thinking about the folks that are joining us today, we've got government officials, economic development officials. We have developers, contractors, construction companies. From your experience, what do you say is, when does the pursuit of these incentives, when does it make sense? Is there a dollar threshold? Anything that comes to mind when folks come out to you and say, is this worth our while?
Yeah, that's a question that is one that's, I guess, it's a relative type of an answer. What is worth it to one company or community to another? So if you're looking at a project, or you're a community that is thriving, you might have a higher benchmark on the requirements that you will have to help attract the company, and then any tools behind that. And those requirements might end up being a certain number of employees, a certain level of minimum investment, and perhaps some average wage sort of requirements to that. If you're a community that's is distressed, if you will, and is looking for a way to grow and diversify, then you may not have any minimum requirements. But the question around from an economies of scale perspective, to go through this process, right? We're talking about, from a sales tax sharing perspective, I would say, and again, this will mean different things to different people on different projects, but a $10 million investment project with, at least 100 employees is, to me, a good starting point to perhaps start having those conversations. And then the amount of sales generated becomes a bit of function of what the allowable sales tax component is in which a community is able to share, right? So some communities, Cynthia, you and I worked with a project in Texas, right? So in Texas, you typically can play with a 1% essentially on the sales, and that then gets shared in some way, shape, or form between the company and the municipality. So 1% of the sales that are generated out of that facility, translates into something, right? So, it's a little bit of you look and see what your projected sales are going to be, and then you justify, is it going to be worth going through the, there's a legal component to it, right? On the agreements that has a certain cost component to it, right? To justify, if I do this and I get this kind of benefit, I'm going to recoup my, my investment in this in 1, 2, or 1 month. So it's a little bit of an exercise on the scale of the deal.
Sure. And in your answer, you were talking a little bit about the eligibility. So let's focus in on that. Alex and I, we were talking that there really aren't many unique eligibility requirements that relate to the sales tax sharing, except perhaps a certain threshold of projected sales. But let's talk through here and some of the typical eligibility requirements that we have run into in the work that we've done together or individually. So with the job creation, I've seen projects or incentives where it's been pretty minimal, 25 to 50 employees, but it runs the gamut to 1,200, 1,500 employees. What is your experience?
Yeah, same. I think when you start talking about the sales tax piece, right, it's it perhaps has to do with, if you're talking about a sales tax sharing agreement, you're more than likely looking at some sort of fulfillment center or e-commerce facility that has a business to consumer component to it, which is what would generate that sales tax. And that tends to have a fairly high capital investment in some of these fulfillment centers. So that 50 or so employee requirement that you were talking about it's a good, I would use plus or minus sort of number to talk about, but not necessarily the magic number. As I mentioned before, it can be as low as 10 in some markets that communities want to see at least a certain number of jobs being created. But it's perhaps the investment and the potential sales generated from that tends to be perhaps more in the conversation than the jobs. But again, we've seen communities where, like you said, there is no requirement, right? There is no minimum, and some that have some, right? So for those listening that have one or don't have one, just know that it varies significantly depending on where we're looking at our project.
On job creation and job retention, something that we have to think about and that has to be reflected properly in an agreement relates to the definition of what an employee is, maybe what's a full-time employee, what's a full-time equivalent employee, for purposes of gauging compliance with the agreement. And oftentimes companies want to make sure that certain potentialities such as voluntary leave or short-term or long-term disability, that notwithstanding the fact that that employee isn't physically working, that there's a safe harbor for that, and for that time that those hours would count toward meeting the definition of a FTE. What do you see about wages and wage expectations or requirements?
Yeah, so the wage component to any project, I've been doing this for about 18 years, and I think wage has been something that I would say easily in the last 5 to 10 years has been something that has had more of a focus than perhaps before as communities become more sophisticated in defining their economic development strategy. So what we see is the more business-friendly sort of requirements are pegging the average wage of the workforce. And again, I'm using the filter of a sort of e-commerce component where you would have workers that are, have that skill set, right, as far as the level of the wage. But we typically see that, some sort of pegging to the federal minimum wage where you would have to pay a certain percentage above the federal minimum wage. 150% is something that we see often on minimum requirements in many markets. So that would be close to $11 an hour would be the minimum requirement. And in some markets, that wage might be defined by a community. It might be closer to the $13, $14 an hour. Or it might even be pegged to the average of the county as well. So that's one that's fairly prevalent in a lot of markets where you have to pay the average of the county, which is, good and bad depending on how you're looking at it. But as you know, wage pressures just on talent is something that the market itself is driving some of those wages up, regardless of the criteria required. But if you look at the actual, statutes and laws, pegging to federal minimum wage and having some percent above that or to the county is generally what we see. So as you're looking at projects, understanding the average wages and the minimum requirements on wages that you're looking at to then understand what you're going to have to do to get some of these incentives or enter into some of these agreements becomes something early on in your due diligence that you would want to address.
Sure. And to that point, do you find that the local jurisdictions can provide certain level of flexibility on meeting those targets, or are they statutorily imposed, or just politically, this is the target that we really need to have? Have you found that that is something negotiable, or and I would think more recently, just an important factor for coming to agreement?
Right. Yeah. So in some cases, as long as the minimum requirements, if they're in a statute, as long as those are met, that's obviously the first step. But in some cases, what happens is a economic development agency may have its own policy in place that they want to run with, and it's a policy. So it's something that certainly can be changed if the community is really interested in pursuing this type of project. So is it negotiable? Yes. But I would say that's you would have to have a pretty willing community in a sort of kind of home run type project for those sort of things to really become part of the conversation. There are sometimes leeway around if a company is within a certain industry target, where some of the requirements might be, you might be able to relax those because of that. So that factors into it. But oftentimes it's a policy developed that perhaps, uses some statutory component to it as a basis or as a floor, if you will. But keep in mind the sales tax sharing piece that we're talking about here is mostly the states do not participate in that unless, again, it's a very unique sort of project for a state level tax. But from a sales tax sharing perspective, that's more of a municipal component. So a municipality would have the discretion to grant it or not. So a sales tax sharing agreement itself is fully discretionary. It's not everybody gets it. There's a short component to it, right, that has to be approved by the proper board, council, what have you, at the local level.
Right. All right. Just to finish off on our bullet points here on this slide, in addition to wage, we run into certain minimum benefits that might be required, usually just to be offered to the employee as something that they can buy into. I haven't found in my experience where there are certain benefits that have to be mandated and provided by 100% pay by the company. Alex, have you ever run into anything like that where there are minimum benefits that but not only have to be offered but paid for by the company?
Yeah, we see that. We do. There are those where the definition of full-time jobs will have to include a minimum level of fringe benefits offered by the company. It doesn't mean that the employee has to take it, right? But it has to be offered by the company. So that is something that helps. I believe it's a good practice for a community to try and incentivize quality type jobs, which are providing those employees with these kinds of benefits that will help the community as a whole, since they have access to those benefits from an employer. And again, I think from a pure market-driven perspective, I think that's something that any employee will look, right? So if you're an employer that's not providing those those benefits, you may have a tougher time getting that. But absolutely, the requirements on that fringe benefit component is something that we see fairly often.
Yeah. All right. Well, and then we've already alluded to capital investment, but oftentimes in these agreements, there'll be a covenant that the company constructs the facility, and clearly, if you're going to be sharing taxes from sales there, you have to have a facility. So let's move on. Let's assume that this is a vehicle that a company wants to pursue. Let's talk a little bit now on how the process. So somebody calls up Alex Fry, and then Alex helps them through the process, and eventually Alex calls somebody like a Voorhees, or the company calls someone like a Voorhees to help pay for a document. But tell us a little bit about the process to actually obtain this, from beginning to memorializing the terms.
Sure. Yeah. So when our team's involved, we typically would have gone through site selection type exercise already to help the company identify where they want to be, whether there's a supply chain piece to it, labor is a component to it, taxation, labor rates, things like that. So we would come in with that information early on. The process, once we've identified markets that work for the project, it's we like to engage with the communities, present the project, highlight things that are important to them, about how good are the jobs, how many jobs, a little bit about the company, explain the investment, and then just help the communities and the states understand where they can help on helping the project and what are going to be some of the things that are important to the company themselves. But really, as these incentives in general are designed to help sort of mitigate one-time and recurring costs, but also to level the playing field among a location that might have a lower cost or qualitative component to it. On that, so we try to have a open dialogue with a community or with a state about that, and provide them with as much information as they need to make a decision on whether or not they're looking to underwrite a project like this, and then go through the process. An important thing that I do want to mention, it's always, based on our experience, that once we've sort of engaged in the details of a potential incentive package and we're sort of getting into offerings, it's always beneficial and good to have, somebody like you, Jacinto, or Vorys, or a law firm on board, especially as it relates to the origination of the sales tax, right? To make sure that we can define whether or not a sales tax will be truly generated in the facility. But not just that, also to be able to address any legalese that are not business term related about the process to the company. So we like to do that, or we like to recommend doing so and have that in place really as we're starting the negotiations, or at least once we've started getting some offers back from the communities, to have sort of a legal eye over that as well. And then, of course, getting to the specifics of documenting the deal, getting the approvals in place and agreements, MOUs, whatever that might look, bonds in some cases, whatever that might look like. It helps the project move faster, and helps answer questions to a company sooner rather than later when you're looking to move quickly to execute a real estate transaction where you're taking something to a board or a CEO to say, here's the deal. And they start asking very specific questions that may not have been addressed yet, which tend to slow things down.
Yeah. All right. Well, let's assume we've gone through the process. You've worked with the local governments and you're memorializing the terms. Let's take a look at what are the customary economic terms for these tax sharing scenarios.
So the customary terms that we see is, as it relates to sales tax sharing, it would certainly be a minimum or some sort of projections on what the sales overall are going to be out of the facility. There's no sort of open-ended sort of, or at least I haven't seen a community just do a purely open-ended sort of sales tax sharing agreement. Communities want to budget and know what their revenue forecast might show, but there would be a minimum number of sales, based on a certain schedule in terms of number of years or year over year, as far as minimum requirements of sales, and those minimum requirements would then be tied to some sort of default or what have you component in the agreements. So those projections, have to be really analyzed internally by the company well. But the minimum sales and then the maximum sales would be defined in the agreement as well. So we see it often. But in addition, we would expect, and we typically do see, a requirement around the number of jobs being created along with the project and meeting the investment that or certain investment, again, based on a certain schedule. Sometimes projects take a couple of years to ramp up, depending if there's new construction or, if it's a more complex sort of a project. So it would be defined. So jobs, investment, sales, something that we would see. Wage sometimes comes into that as well, right? Paying the minimum wage in that. And then, of course, let's see, we would have sales tax sharing, the wage, jobs, and the investment. Yeah, so those are generally speaking the main requirements of that. In addition to that, in some cases, we see additional requirements being thrown in that are contractually required. The use of certain vendors, MBE, WBE sort of requirements are sometimes part of this conversation as well, where there's minimum requirements in there. So, understanding what you're going to have to do contractually is something that we like to define early on before we actually get to the actual agreements phase. But that's something that we would see memorialized in the agreement. And that's, again, where the legal piece of that is a key one to understand so that a company can identify their potential liability or exposure should they fall short of their requirements, right? The what if sort of conversations.
Yeah, and that's right. So in addition to the economic terms, we're going to have some of the covenants of the company to perform in order to receive the incentives, and other legal issues to be addressed. Some of the customary legal provisions are here on this screen. You'll have representations both of the company and of the counterparty, the government. Oops, pardon me. There we go. There was a gremlin there. But representations, and as all transactional lawyers know, you try to avoid making representations to the extent possible or qualifying them. But typical representations would be the authority of the company and that signatory to enter into the incentives. At the same time, on the company side, with respect to representations and authority, the companies will want to make sure that the proper legislative process has been performed to approve these incentives, and incentive council will be reviewing those. There'll also be representations with regard to the viability of the project or the ability of the owner to perform on the project. Sometimes there'll be representations with respect to following laws, or that the project is properly zoned for the location and whatnot. Assignment is a very important provision for a company. Typically, the jurisdictions are amenable to having the ability for the company to assign the incentives to an affiliate. In some cases, the benefit flows to the owner of the property, yet the operating company is either ground leasing or leasing through a triple net lease the projects, and so assignability for financial business considerations is important. Jurisdictions are less keen on making them freely assignable to a third party in situations. So, Alex, you referred or mentioned earlier about compliance or following the covenants of the agreement. Depending on the agreement, depending on if it's earn as you go or if it's more upfront, the use of clawback is of relative importance to the jurisdiction in the event that the company doesn't perform. I've seen clawbacks that where, if it's a material default, that all the incentive that has been earned or accrued to date has to be returned to the company or to the government. But we try to negotiate a gradual or gradated callback based on how far off the mark the company may have been. And it's a matter of equity and reasonableness. Companies perform 90% of its obligations. Is it equitable for them to go back to zero? Alex, in your experience, have you seen anything different than those types of callbacks?
So, as you know, there's a couple different tiers in the clawback, right? Some are, if the company is just flat out not able to perform for business reasons or something falls through, the callbacks might be that you just don't get the benefit in the future, right? That you don't have to pay back anything in the past. So that's what I would say is what we see most often. I think the more serious clawback provisions that we see are tied to if a company like shutters a facility or relocates the facility out of that municipality or the state because they're gone, right? So that wasn't part of the deal. But so there's sort of those two different levels of potential clawbacks. But in some agreements, as you know, and when you guys negotiate them, Jacinto, there's cure periods,
Absolutely.
All these force majeure, and I'm sure, the legal world is going crazy on how you define force majeure with pandemics now, which, it's a conversation everywhere.
Yeah, that's a conversation for another day.
And to be tested, I guess, in the future. So yeah, and I think that it's good practice for any community to have callback provisions. I think it's the right thing to do, and because the intent of these incentives are to get a return on investment for the community, and it's a partnership between the company and the municipalities, and it should be fair, I guess. Components we've seen some clawbacks in some areas that are just completely off base and out of line. And that's just sort of the policy of those communities. But I would say the majority are more performance-based. And if you sort of fall out of favor, there's a cure period. And if not, you're sort of kicked out of the program.
Yeah, thanks. So moving on, remedies, and we have already previewed that because the callback is one of the significant remedies, probably the most draconian, aside of terminating the agreement. With respect to termination, not only would we address termination for the failure to perform under the contract, companies also would like the flexibility to try to negotiate the ability to terminate the incentive agreement if, for whatever reason, the project or the metrics that have been that initially were considered may not align with the company's goals or situation. So being able to provide that flexibility is important for our company. Focusing in on some state-specific provisions, depending on where you are regionally, there are different policy considerations, different perspectives of things. Typical provisions that you might see are non-discrimination provisions, and you'll see that throughout the gamut. But in some states, you'll see them there, and other locations that may not be addressed. There'll be provisions with regard to compliance with state laws, and something that we focus in on as companies is trying to focus in on violations at the project that relate to the law, as opposed to if you may have a facility somewhere else in the state and there might be an issue, and that client isn't under this exemption. We don't want there to be sort of a cross-default situation. And then in some states, particularly in Texas, you have provisions relating to hiring undocumented workers, and that notwithstanding the fact that you may have a more lenient remedy for other defaults, violation of immigration laws would result in complete clawback. So moving forward, Alex, you and I talked quite a bit of this in our preparation, and thinking specifically with sales tax and sales tax sharing, what is the reporting mechanism and monitoring to measure compliance?
Yeah, and this is probably the one piece that not just for sales tax sharing, but in general, where we see most companies get tripped up, is on the monitoring of the paperwork, information, reporting required to keep your incentives or to get your incentives over time. Companies usually don't have dedicated staff to handle this. There's turnover within companies and things just don't get done. So, from our side, right, like I'm talking about the experience from our team, where we do have dedicated people that help our clients with monitoring of it. But normally with these kinds of reports, you would likely have a quarterly sort of reporting that you would have to send in on the sales tax that has been generated and paid to Department of Revenue or Controller's Office, whichever it is, to keep track of that. And then that is the reporting that would be used to then, validate, monetize the tax that you actually get back, right? Because essentially you mentioned tax asserts. So if we stay on that example, the tax gets paid to the Controller's Office, which is a state entity, and then the Controller's Office essentially is able to give the money back to the municipality, and then that gets shared with the company, right? So the reporting is an important piece. We recommend reconciling monthly, not quarterly, from a number of sales perspective, the pure actually sales piece of it. And then, normally we would see an annual, sometimes a quarterly report that has to be submitted to comply or to prove compliance with, or not compliance, but yes, compliance, I guess, with or a progress report, if you will, to show how many jobs you've created, the wages that you're paying, and proof of expenditures and use of certain, vendors if required. So it's something that requires constant attention, based on our opinion and experience, but it's something that should not be overlooked, right? As you're looking into getting into a project like this, do you have the team in place or the resources in place to help you with that? Because going back and getting some of this, in some places you can't go retroactive. There's certain deadlines, so if you miss it, you don't get it. Some areas in some states you can, sort of has a longer tail on it, but you want to be on top of it. You don't want this to get away from you.
Right. Yeah. And with respect, I'm just curious, with respect to the projects that you have assisted on, for the most part, do you also aid the companies in the monitoring element, or do they oftentimes say, hey, thanks so much, we'll take care of it? And in the cases of when they say, thanks, we'll take care of it, do you find that sometimes they come back and say, hey, can you help us?
Yeah, and we're starting to see that more and more, Jacinto. More companies are wanting us to handle the monitoring of their portfolios or their incentives, because in a lot of places, the reporting requirements have become more complex. Rightfully so, communities and municipalities are trying to be more transparent about the sort of public benefits that are being provided to companies. So it's an important piece to have. So we stay involved with our clients early on, and then once a certain rounds of submittals have been done, then if a client asks us to step away, we will. But otherwise, we generally stick around and help our clients with the reporting throughout the term of that. And we've had companies for which we haven't negotiated incentives come to us and say, I didn't know what I was getting myself into. Help me with this paperwork, and then we'll help those companies as well on the monitoring side. But a big important piece, and we have tools and technology built just for monitoring the incentives. And so we've spent a significant amount of resources and time to have that in place to help our clients.
Great, great. Well, we're going to wrap up the first part of our presentation here by just going over a few samples or examples of different states that we've worked with in some of the programs. Specifically, Alex and I collaborated together for a client on a Texas 380 and 381 development program. The distinction being that Texas, this is the reference to the Texas local government code. 380 relates to municipalities and 381 relates to counties. Their statutory authority are very similar, but essentially this is a very broad statute where counties and local governments may enter into agreements to promote economic development. You'll see, in my experience, it's compared to other states, it's pretty broad in the sense of what the agreement can look like. Obviously, there are state constitution and statutes and regulations that still apply, but there seems to be it's less of a cookie cutter approach. There's a lot of flexibility where you'll see, in addition to sales tax sharing, you'll see exemptions for the personal property tax or for the cost of the sales tax, rather, for the construction costs for the construction materials and also for equipping the facilities. So we have the 380 and the 381. Then just as a point of reference, here is a list of certain programs of states. California, we'll talk a little bit further about that they do promote sales tax sharing. Alex, you say you're working on a transaction in Idaho currently?
Yeah, so we're focused on mostly the Idaho one. I think we can talk about perhaps under the in the next section of this is probably what it's going to lend itself best to. But certainly the sales tax sharing, Texas, California, Illinois, are states in which we see a lot of the sales tax sharing as being an option. But I think we can jump to the next section here to.
Sure. Yeah, very good. Very good. And then in Nevada, typically that's part of a larger package. And just incidentally, in Nevada, the incentives are managed at the state level as opposed to the local level, at least for some of these larger incentives.
Yep. Right. Yep.
This isn't the main focus of this presentation, but wanted to focus in a little bit on e-commerce and tax sharing, just because this is not incredibly recent news, but within the last year or so, we've had a situation as a result of a 2018 Supreme Court decision, South Dakota v. Wayfair, that stated or held that states may charge sales tax on purchases from out-of-state sellers. And that decision spurred legislation to address that, and also indirectly created scrutiny on the treatment of intrastate sales in some states, including California and in Texas. Typically or traditionally, brick and mortar sales were origin-based, so they're taxed at the location of the sale. And the treatment of the interstate sales can create a substantial benefit for the locality where the distribution center is located. And we've worked on, and I've seen a number of tax sharing agreements in various states where the whole premise is set up that the sales coming from that distribution center or e-commerce sale hub would be attributed to the location of the business and not the destination of the delivery. And for policy reasons, certain jurisdictions saw that as not equitable, and that those local taxes should be going to the city of destination. Recently, in Texas, the comptroller changed the rule, proposed to change the rule from the city tax going to the city where the distribution center is located to the destination. That rule change has been delayed through to the fall of 2022, ostensibly so that the state legislature can create a legislative fix and determine as the legislative body what the policy of the state will be. In California, in last year, or 2019, Governor Newsom was faced with two competing bills. One would have made it illegal, would have prohibited any further sales tax sharing agreements in California. And he vetoed that bill, but then he did pass a competing bill that put some restraints and more so reporting requirements concerning sales tax sharing agreements for this purpose. Seeing that the governor took the opinion that this is a benefit to states, particularly smaller communities within the state needing to create jobs, and took the policy position that overall tax sharing agreements were beneficial. Moving to the second half of our presentation, we're going to be focusing in on construction project exemptions. And one of the questions from our audience related to pointing out how in Ohio, the port authorities have the ability through capital restructure to help certain projects benefit from a sales tax exemption, and we'll be addressing that. And to the extent that we don't answer your questions, Alex and I will do our best to get back to you with responses to those online questions. So thank you. Generally, that sales tax is required to be paid on construction materials and equipment and personal property, and many states have exemptions for the U.S. government and for the state or political subdivisions. There are some states that provide sales tax exemptions for companies and doing different projects. So, Alex, you mentioned in our discussion that you've worked on some states projects that permit or provide the sales tax exemptions on construction materials and even on machinery and equipment.
Yeah, and Jacinto, on this, you know, the sales tax conversation and exemptions thereof is one that is, you know, a longer sort of deep dive discussion that can be had on a project for which we wouldn't have enough time. But as many of you may know, a lot of states have just built into their tax code certain exemptions on certain types of equipment or uses, right? But generally speaking, what we call the general sales tax, which you would see on, you know, if you went shopping or a business buying a chair or a desk or what have you, those are some of the, or if a construction company is going out to buy steel and, you know, lumber and things like that, some of those activities are generally taxed. There's no exemption on that. Whereas in some states, there's a full exemption on production equipment, you know, pollution control equipment, things like that are by tax code exempt. But what we're talking about here is opportunities from an economic development perspective where exemptions on those taxes that are normally not exempt under the tax code that you can pursue. And the opportunities and options are fairly broad and are unique within themselves, depending on where a project might be looking at. And on the slide, we have just a few listed. You know, if you're with a community and or state on this session, and you say, why am I not out here? It's just, you know, we're just using some representative states on that. But, you know, for example, in a state like Georgia, Mississippi, Arkansas, Missouri, there are ways of exempting sales tax on things that would otherwise not be exempt. For example, construction materials, and the mechanisms that you use for that vary. In some states, the exemption is granted in the form of a letter from the state to say, here's your exempt letter that you can then pass on to your general contractor. And general contractor, you can pass on subcontractors, and therefore there is no sales tax that has to be charged as far as that. So that's the exemption piece of this. And in some cases, you have to use a bond to do so, where the municipality has to essentially take, like a bond for title time transaction. We see that in states like, Mississippi, Arkansas, Missouri has some of that in Kansas. And I'm sure there's others that I'm mentioning right now. So you have to go through a bond process to do so, to get that exemption. And in others, like Jacinto mentioned, Ohio has a fairly unique one, somewhat involved one here that you can sort of weigh in on how that works specifically under an Ohio solution.
Yeah. So, everything is going to be state specific, but being an Ohio lawyer, I've worked on quite a few of these, and I thought I would just use this as a general representation of what these programs look like. The sales tax exemption on materials and services for buildings relate to materials and services sold to construction contractors for the incorporation into a structured improvement. Alex alluded a bit to the protocol, and in Ohio, the approach that port authorities help in aiding these sorts of projects are through a capital lease structure. And on the screen here is a typical outline of the transaction. So you'll have a project, you have the owner, the port authority will ground lease the real property from the owner. Then the port authority will enter into contracts, construction contracts, through a construction management agreement with the owner. So the owner of the building or of the real property, or an affiliate, acts as a construction manager for the project, and the port authority leases the project back to the owner. And the owner may sublease it to an end user, or the owner may be the end user. Keys are that the port authority has no obligation to fund the project, fund the construction, other than to the extent that they might be issuing taxable lease bonds. In Ohio, some of the projects don't incorporate this step, and many port authorities don't require this. Other port authorities, in fashion, as Alex mentioned with other states, would have some sort of bond issued in connection with this transaction. And to the extent that if bonds are part of it, they would be purchased by the property owner, and they'd be payable from the rents made by the owner under the lease. During the term of the lease, the port authority will continue to own the property, but subject to the leasehold rights of the taxpayers. Who receives the exemption? The contractors do, and in that process, then the contractor is able to obtain the materials tax-free and therefore not have to pass the cost. There are certain items that don't qualify for the exemption, and that would be business fixtures relating to the project, to the specific use. But I want to point out that certain items like HVAC that are just general use for the building, those types of materials or items would qualify. Items of personal property, notwithstanding the fact that they're affixed to the building, if title hasn't been transferred to the owner or the lessee of the real property, the exemption doesn't apply. The exemption doesn't apply to certain items used in the process of constructing, for instance, like shoring lumber or construction elevators or whatnot. And I've had that issue where a client has asked about that, and because they were charged sales tax on that component, and they were questioning that. Certain items, other items are also not covered, like carpeting and improvements to the landscape. In Ohio, the simple mechanics, I know we're finishing up on time here, but we are able to go over about 2 or 3 minutes, and we'll just finish up and call it a session. In Ohio, for the mechanics, we'll provide the links here for the form, but essentially in the case of a Port Authority transaction, the Port Authority would sign under the political subdivision and provide that to the contractee, the owner of the building, who then provides it to the contractor. The contractor would keep the certificate, needs to be posted on site, and the contractor would also share it with all of its subs. Something that Alex and I talked about with regard to these projects too, and in other states, is important to have in your contracts with your contractors provisions that they will provide the certificates to their subs, and to the extent that, because unlike Ohio's program where the exemption is immediate, in some states the exemption is a refund, and you need to provide backup documentation. And to that end, you want to have your contractor and subcontractors covenant that they will provide the necessary background documentation. So with that, Alex, do you have any further thoughts on the construction materials exemption?
Only that the actual keeping records of the information is key from day one. As I mentioned, it's good to keep reconciling this information on a regular basis and have a tool or a SharePoint or whatever to do so. So, and I think to your point about making sure the contractors are aware of this early on, we always stress that on projects with our clients. We even recommend sometimes to take it as far as having clauses with your subcontractors that payment can be withheld if they don't provide the reporting, to really get them to do so. You know, some vendors are very sophisticated, some are not. So it's an important piece on the compliance side, but certainly it can be a tedious process because of in some cases, the volume of potential purchases and POs and invoices that are there. Sometimes you have to even, provide proof of payment and things like that. So just an important thing to consider as you're pursuing some exemptions that are not, as of right sort of exemptions that require some sort of, validation on the revenue side, on the other side, that are providing either the exemption, the rebate, or some combination thereof.
Sure. Thank you. Well, we do have a handful of questions that unfortunately we don't have time for, but we will do our best to get back to you individually to provide answers to your questions. We appreciate your time, and we hope that you've enjoyed this. And please fill out the questionnaires, surveys. That will be helpful for our planning of future programs. Thank you very much. Thank you, Alex.
Thank you. Thanks, Jacinto. Thank you.